Thank you so much being here virtually, Vasile.
My pleasure.
So we have the honor interviewing Richard Windsor, founder and owner of the research company Radio Free Mobile, covering the global technology sector. So I want to start talking about the current state of our world. Then we can move on to what the future could look like. Then we'll talk about your world, your expertise on technological advancements.
Okay.
So let's move on to the first question. So Federal Reserve's June meeting, which grabbed the attention of investors from all around the world, ended. Beyond the impact of FOMC, what do you predict is next for the technology industry? Like its prospect, related stock prices, whatever you think.
Yes, there's a couple of things to unpack here. Firstly, you've had a 75 basis point increase in the interest rate. Now, that was largely expected. So in terms of expectations and valuations, I don't think it impacts the technology sector very much in terms of overall price action as a result of this increase. I think what the technology sector and probably the stock market in general is pricing in is an increase in the base rate of interest to probably something like 300 basis points. But if it starts to go beyond that, you're likely to see the technology sector probably continue to correct. That's the one thing. The second problem you have right now is that with inflation at 8.6%, and it's not just US inflation. What happens is, because the US dollar is the world's reserve currency, the United States is able to export its inflation elsewhere. And that means when the dollar sees inflation, you see it right the way across the world. And the net impact of that is going to be probably slower demand from consumer devices, from digital advertising. The main revenue streams that make the technology sector tick over today are likely to come under some pressure. So the outlook at the moment is probably going to be slower growth overall, continued rotation, I suspect, away from growth towards value as people seek to protect their money from the impact of inflation.
Okay, so you were saying that 75 basis point up hike is quite moderate, so maybe slower growth is expected. But do you agree with the argument that the tech stock crash will continue? Like, FANG era is over. How do you think about this argument?
I don't think the FANG era is over. If you look at Apple's revenues, if you look at Google's revenues, Amazon's revenues, these companies are not suffering sudden declines in revenues, which would imply that, they're being competed away or their financial strength has disappeared. What's happening is that the growth outlook for these companies is lower. And when the growth outlook for these companies is lower, the share price is correct and the valuation's correct. Give you an example, it wasn't that long ago that Apple was a company trading with a single-digit price-earnings ratio. Now the company has a price-earnings ratio of over 25. And so consequently, what is going on here is the sector is being derated by the market. It doesn't mean that the revenues are going to be less. It means that the revenues are going to grow more slowly. And as a result of that, the market is not prepared to pay such a high multiple for those earnings. That's really what's happening here.
Okay, so among all those tech stocks, Tesla is most owned foreign stock in Korea. So, and it's interesting because, Cathie Wood is buying extra shares of Tesla, saying that it's already bottomed and she thinks it would one day recover. But in a totally different view, I think you implied in a CNBC interview last April that Tesla's stock price is sort of overpriced. So as Elon Musk has a lot more in his plate. What do you think is more reasonable stock price for Tesla?
This is a very good question. And the answer is that nobody knows. And the reason why nobody knows is simply because Tesla is not a company that is trading on valuation or fundamentals. even where the stock is now, the company needs to win 30% of the entire world vehicle market share over the next 20 years or so, just to justify the current valuation. So this company is not trading on fundamentals. What it's trading on is a narrative, a story about the takeover of electrical vehicles, taking over petrol vehicles, and so on and so forth. And when stocks trade on story rather than fundamentals, it's impossible to put a fundamental value on them. Now, what that means to me is that if Tesla is currently pricing in 25, 30% of global market share of vehicles, I think it's very unlikely that Tesla ever reaches that level of market share. So I can comfortably say on a fundamental basis, the valuation of Tesla should be significantly lower than it is today. And the way I would achieve a valuation, which I haven't done, but if I was going to do a valuation, I would look at, well, what market share of the vehicle market do I think Tesla can win over a 20-year basis? And estimate what my long-term value of Tesla is based on that, rather than a story or a narrative that's being put out by the market and by the company.
So can you tell me more about the story? I couldn't really get what the story, like narrative of Tesla, like what is it?
It's actually quite simple. So firstly, the story is that Tesla will get a very large market share of electrical vehicles. Secondly, the story is that Tesla will be first to market with a functioning autonomous driving solution, which will enable Tesla to run a robo-taxi service. Now, Tesla's anticipation of this robo-taxi service is that the cost to deliver this robo-taxi service will be maybe 35 cents per mile, and it will be able to charge $1 a mile, giving the company a gross margin of 66% and arguably enormous cash flow over a significant period. All of the analysis that we have done indicates that this will not come to pass. Two things, I won't go into them in detail, but two things is, one, we believe that the approach of Tesla to artificial intelligence is not the right approach to get a working robo-taxi solution. And two, when it does get to market with an autonomous robo-taxi solution, there will be many, many others available. What this means is that a robo-taxi service won't have gross margins of 66%, it might have gross margins of 20%, meaning that it becomes an industry about scale and volume and efficiency. And on that basis, again, that's where ARK is getting its $5,000 price target of Tesla or whatever it is. And frankly, we can't even get close to that. Simply because we think that neither of the two assumptions that ARK is making in its long-term forecasts are going to come true.
So due to the recent disruptions in global supply chains, like shipments of electronic devices have been decreasing, and forecasts for DRAM and NAND flash prices have been declining. How do you see the outlooks for the major chip makers and its stock prices for the latter part of 2022?
On the supply side and the supply constraint, falling DRAM prices and falling memory prices is not an indication of a shortage. And this is something else we've also seen. If you look at what some of the Japanese companies have been saying is that they have stopped building inventories of components because they have enough to weather any shortage. What this means to me is that we are getting to a point, perhaps not yet, where peak demand is past. Maybe demand softens a little bit due to inflation and the weakness in the economy. And we are close to, if not at, the peak of the semiconductor cycle. Now, most of the semiconductor companies will tell you that the shortage will continue until the end of this year, and perhaps that might be the case. However, in 2023, there should be a lot of more capacity coming on stream in the semiconductor industry. And it's quite possible that at the same time, demand continues to weaken as a result of the poor economy and inflation. And the net result of that is that we go into a down cycle for semiconductors. Now, what tends to happen every time is everybody always says, oh, the semiconductor cycle is different. This time it's different. That is true, but it's always a cycle, which means that when you get a very, very strong leg up, you tend to get a strong leg down. And that's where I suspect the semiconductor industry is going. At the moment, 2022 looks okay. I would be more concerned about the outlook in 2023.
Okay, so you told me about 2023 that it would have another inflation. So do you mean that we will face another, slowdown in 2023?
Yes, we don't think inflation is going anywhere. This whole notion of transitory inflation that was put out by the Fed and much of the market in 2021 has been proved to be completely incorrect. There is no indication that inflation is going to fall, and there's a very simple reason for that. If you want to tackle inflation, you need to have real and positive interest rates. Right now, even if the Fed increases interest rates to 3%, real interest rates are still negative to the tune of about 5.5%. When you have negative real interest rates, you do not necessarily are able to combat inflation. In order to combat inflation effectively, the Fed would need to do something similar to what Paul Volcker did in the 1980s and take interest rates up to 10, maybe 15%. But because now the financial system and the economy is so much more indebted, there is no way that the economy could stand that kind of level of interest rates, nor could the stock market, nor could the real estate market. And so the outlook really is that the Federal Reserve and many other central banks across the world are unable to do what they need to do to really combat inflation, which means inflation is here and it's going to be here for 3 or 4 years until the value of the money supply has been decreased by around about 30 to 35%. And we're in a situation where the money supply and the economy are back in balance.
Okay. So you're saying like 3 to 4 years are required for everything, to come down, right?
Yes, at a very high level, the way I would look at it is like this, is the US increased the money supply by 33% in the same year that the economy crashed. Now, the economy has come back somewhat now, but what needs to happen is that the value of the money supply needs to be inflated, probably somewhere around about 30%, in order to bring it back into balance with the economy. The way it's supposed to work is the money supply increases in line with the economy in order such that there's enough liquidity in the system for transactions to be carried out. Part of the problem with a gold-based economy is that there isn't enough gold around in order to facilitate all of these transactions. What the Fed did is it basically bailed out the system with a huge increase.
So I saw your daily blog, and as you wrote in the daily blog, crypto heads for a dip freeze, there are some signals that the crypto companies will follow the similar path of that of internet enterprises did during dot-com bubble crash. So only few survive, just like Google, Amazon. Are there some crypto companies that, in your opinion, could possibly survive today's crypto winter?
Yes, I think Bitcoin survives. At what level, I don't know. But I think certainly Bitcoin will survive, Ethereum will survive. Of the other 20,000 cryptocurrencies out there, I have no idea. I actually think Coinbase will survive. The reason why I think Coinbase will survive is because the way to look at Coinbase is that it is effectively an unregulated bank. So customers deposit cash with Coinbase, and they then buy cryptocurrencies and they're able to transact in cryptocurrencies using Coinbase's digital wallets. Coinbase's liabilities to its customers, cash that is deposited in Coinbase that has not been converted into cryptocurrencies. And that cash is sitting inside Coinbase. So if all of the customers say, I want my money back, Coinbase can deliver it back. So there is unlikely to be a run on Coinbase like you would see on a traditional bank, which has lent all the money out. So from that perspective, Coinbase will be able to survive a run by its customers. And so from that perspective, I think it survives.
Okay, thank you for sharing your thought. So the follow-up question is something, let's go a bit more broad question. Can you share some points that technology investors should check before investing?
That's a good question. Well, as a fundamental-based analyst, investor, the first thing to do is you have to understand the company. You have to understand what it does. You have to understand the technology that it is selling and what use that technology is. You then have to also speak to the management. You have to gauge whether the management is any good, or whether the management will fail to execute. You then also need to look at the fundamentals of the company. What revenues could it generate? What profits could it generate? And it is on that basis that you should ascertain what the value of that company is. And it's not until you can work out what you think the value of that company is that you can have any idea whether the price of the stock is too high or too low. So that's really how I would look at it at the moment.
Okay, thank you. So, can you share your philosophy? I think it was your major, right?
No, I'm not a philosopher.
Oh, really?
No, I'm Doctor of Philosophy. My doctorate is actually in immunology. So.
Oh, immunology.
Virology.
Oh, okay. Then I got it wrong.
I'm not a philosopher.
Okay, I got it wrong. So, can you share your philosophy of managing your own investing portfolio?
I seek for value. I look for value. I like to be my nature as an investor is contrarian, which means that I like a share price, or I like a company where its share price has fallen by 85%, because if we're in a situation where everything is being sold regardless, the good companies will be sold with the bad companies. And so from that perspective, these are the kind of companies that I like. I like to look at assets that the market doesn't like, because that's when you're going to get the best price for them. That's when you should invest in the assets, is effectively when they're on sale. So the analogy is, if you go to a shop to buy something, you like to get a 50% discount on that product. It's the same with companies. If the share price of a company has fallen by 85%, but nothing has changed in the fundamentals of the company, you're getting that asset on an 85% sale. The trick and the difficulty is, one, making sure that the asset is actually worth what you think it is. And then secondly, having the conviction and the courage to hold through what is likely to be excessive bouts of volatility.
Conviction and confidence, I'll remember them too. So now finally, before you go, Richard, can you name tech stocks that you're looking at nowadays and would want to share with our investors today?
Yes, so I'm more than happy. I currently own Alibaba. It has not been my greatest investment, I have to admit, because I owned it from 200. What we missed on that is the fundamentals of Alibaba remain intact. What went wrong was the clampdown in the Chinese regulatory environment. Now, the position that we always took on Alibaba was simply that regulation had already passed it by, but that did not stop the share price from getting hammered as all of the other Chinese technology companies got hit with this new regulatory regime. I'm reasonably confident now that the worst is over for Alibaba, and sentiment on Chinese technology is beginning to turn. I've continued to hold Alibaba. I think it's worth substantially more, and the fundamentals in Alibaba point to a much higher share price than what we have today. Another one that I own is a LiDAR company called Ouster. Ouster it makes LiDAR, which is the eyes, if you like, of the autonomous vehicle. Now, there are many LiDAR companies that have come to market through the SPAC process, some good, some not so good. The difference with Ouster is Ouster actually has real volumes and real revenues, and it has those revenues today. As a result, because of the SPAC crash, Ouster is now trading at less than 1.8 times enterprise value to sales, which is far cheaper than almost all of its peers. And it's a real company which has enough cash and liquidity to see it through to profitability. So there's a lot of fundamental value in this company. Another company I'm looking at that I don't own, that I'm thinking about, is Peloton. Another company that has crashed very significantly. And the reason why it's interesting is Peloton is a company in two pieces. The first piece are the exercise bikes. The second piece is the subscription business. Now, when Peloton came to market, I was very negative on the company, and I was very negative on the company all the way from 20, all the way up to 180, and then all the way back down to 10 again.
What changed your mind?
Well, what changed my mind is during that period, the size of the subscriber base went from 500,000 to 3 million. And these are 3 million fiercely loyal subscribers who pay Peloton $45 a month. If you can fix the hardware business and bring it back to at least cash flow or operating break even, the subscription business is extremely valuable. It has 70% gross margin, and it turns over significant amounts of money. With no growth in subscribers going forward, you can value the subscription business at 8 billion. If it grows at 5% over a sustainable period, you could value it at 16 billion. And if the CEO is successful in growing it to 100 million users, then it's worth many more orders of magnitude than it is today. Now, it's not without risk. The hardware business is still a complete disaster, and it requires very good management and discipline to turn it around. But if you're willing to see through that, and this is what I'm looking at the moment, there is substantial upside in this company if they can fix the hardware issues.
Okay, but this is like my question. When we go back to Ouster, you said that Ouster provides LiDAR to the automotive vehicle companies, including Tesla.
No, Tesla only uses cameras. Tesla only uses cameras. This is one of the reasons why its autonomous driving solution is not good enough, in my opinion, is it only uses cameras. Everyone else uses cameras and radars and dominantly LiDAR. Also, what you're seeing is the automation of more than just cars. You're seeing the automation of factories, of warehouses, of dockyards, and all of these robots that are being part of this automation will also use LiDAR. And Ouster is also very good at supplying these companies as well.
Okay, so I asked you because you told me something very pessimistic about Tesla's narrative, and if Ouster is providing technology to them, then they would be linked together. So how can you say pessimistic toward Tesla and more optimistic toward Ouster? So, but now I got what you mean.
But for two reasons. One, Tesla is trading on a very, very high multiple of its revenues, and Ouster is trading on 1.8 times. So if they both went to the same level of valuation in terms of revenues, Ouster could go up tenfold and Tesla could go down 80%. So that's one reason. Yes, it's a normalization of valuation, straight up. Okay. The second thing is that Tesla has made the wrong technological choices for its autonomous driving solution, in my opinion. But Ouster is one of the better suppliers of LiDAR to the automation industry. And it doesn't just do cars, it also does all of the other robots and like forklift trucks and all the other pieces of equipment that are in factories and dockyards and so on and so forth, so that its reach is much wider than just autonomous driving. So for example, it already has 500 customers across the world.
Okay, so thank you again for being with us, sharing your insights today. And I hope all our viewers and investors also receive your message as well.
Good.
So, yeah.
Come back anytime.
Okay, thank you so much.
Yes, bye.
Bye.